Hey guys, how are you?
Hello, how are you?
Hello, hello, hello. Oh,
Howdy, howdy.
hello, how's it going? Caro, Taylor, how are you guys?
Hi, Chai.
It's a
Oh,
beautiful day.
oh my
Just
gosh, so
minus
good. I
minus
was
the
just
rain.
shooting outside, shooting as in camera shooting. Rachel, how are you? Carol, what's going on?
Hey, how's it going?
Doing well, thank you.
Hello, everyone.
Hello, hey Alexis, how are you? I
Good.
didn't see you there for a second. All right.
Give me 1 second.
The star of the show is here already. Okay, let's give it maybe a few, like 3, 4 minutes for people to join. And in the meantime, I'm getting Alexis. Okay, I'll spotlight you, Alexis, whenever you're back on
All right,
camera.
just got back here. You're recovering from a little cold.
You are? Oh my God.
Yeah. Today's like my first day really being able to talk. So
Oh
I'm
my
excited
God.
to share all the things.
Nice. Okay, we got you in the right health and voice. That's good.
Yes. I'm excited
All
for
right,
this.
so we have 3, 4 minutes. Like we can do one fun exercise. If you guys have any question for Alexis that you want her to answer during the interview, go ahead and drop it in the chat or unmute and talk about it while we are waiting for other people to join. Is I don't know where Jada is. Okay, let me text her in the meantime. Any questions you have?
I love it.
3, 5 minutes before we can jump into our questioning.
Yeah,
Well,
a lot of good stuff to
questioning
share
some.
today about private money lending, raising money.
Oh yeah.
The
So
first, yeah,
just
go
to
ahead.
let you know, Alexis, some of like Caro, Taylor, even Rachel for that matter, they are all working with us as a loan officer.
Nice.
And they are super excited to hear what you have to say. They are already taking a lot of action. They are posting a lot of content. I know Taylor is just creating all these crazy flyers every day. I don't know how he does it, but and he's also a police officer, just so you know. So behave properly, everybody.
So behave properly. LOL. I would try not to
I
break
pro
any
I,
rules, Taylor.
I promise that's a lot extra work and you're all fine. Let's enjoy the Saturday.
Yes. Hey, Levi, how are you, man? Do you know Levi, by the way?
I
Levi is
don't.
in Atlanta. Levi is also working with us I mean, he's developing our cold calling process for loan officers and also work trying to uh, be a loan officer himself.
Very nice.
Eric, how are you? Armando, what's going on? Okay, I'm just gonna check with Jada real quick.
Very nice. Excited for this.
Let me see. Did Jada say she's coming or no?
Alexis, are you still in New York? Yes, I just got back to New York. I was in Miami for a
Oh my
couple
God.
days at Art Basel. Art
Erin, how are you?
Art
Yeah,
Basel is
sorry.
such an interesting event. When I was there, of course, there's art and there's artists, but it seems to attract a lot of sort of investor profiles too. So I had some really great meetings there with family offices who have a diverse portfolio, all the way from crypto and art, super abstract things to really and pretty boring vanilla things. So the capital raising journey has been interesting for me. I started raising with like $50,000 checks, and now I'm raising, I'll go into it as we get through the interview, but now I'm raising more of like $500 million, million and a half
Ooh.
dollar checks. So that's
Oh my
exciting.
God. Okay.
But Kara, to answer your question, I got back to New York on Tuesday, and I came down with the worst sickness ever. I was like bedridden for 3 days, and I was telling Chai today's my first day, like really feeling energy at all again. So excited to do the podcast and share all the things now that I can talk and share. And I'll be in New York for the next month, so I'll be here December, now until probably around January 13th, and then I'm headed to Europe for a couple months for a couple other conferences to raise some money.
Y'all,
Nice. Hope you feel better soon. I know it's tough to be in that sick and being able to show up and talk.
I think it was the like transition from hot to cold.
Oh,
Miami was like it was actually really warm, and then I went to Atlanta first and then New York, and it's like 20 degrees. So I think it was just a shock there, but I'm feeling good. Thank you.
nice.
all right, I'm going to get started here in 1 second. Let me just finish posting this. All right. Welcome everybody. Welcome, Alexis. Thank you so much for joining our podcast. And well, this is a combination of underwriting power hour, and we also bring in guests to talk about different things. So we do a slightly differently. Uh, but I hope you like it. Let's get into it as we get started. Give me 1 second. Because it's Alexis, I'm not trying to shoot from the hips and actually prepared my questions because I personally want to know so much more uh, than
Yeah,
our.
I'll start with this. Like when I started lending and really investing at all, real estate in general, the industry that we're in is a very capital intensive business. It's if you're not wholesaling, um, and if no one's familiar with wholesaling, you are assigning a contract. You don't really need money to do it. But if you're not wholesaling and you want to be in real estate, you need a lot of money. You need, oftentimes hundreds of thousands or even millions of dollars to get started. And I managed to, get into the business and be relatively successful without using any of my own money to start. I started in this business when I was 18 years old and have since raised tens of millions of dollars. So the skill set of raising capital is essential if you're going to survive and certainly thrive in real estate. And one thing that I've learned now, venturing and learning different aspects of real estate, learning different aspects of business, is that the skill of raising money is applicable to anything. I mean, I've had nonprofits approach me to try to get me to raise money for them.
Oh
Once
my,
you learn the skill, you can raise capital for a real estate deal. You can raise capital for a business deal, a merger, an acquisition. You can raise capital for a new company. The skill set of knowing how to communicate your offer, knowing how to help people understand the value in investing with you, it applies to so much more than just lending. But where I used it the most was on my private money lending business.
so if you are in real estate and trying to grow, the most important person you need to know is Alexis. That's the
Well, I wouldn't.
short answer.
I'm flattered. I'm honored, Chai. I wouldn't say that I'm the most important person you need to know. I would probably say the most important skill set you need to learn is how to raise money. And
Oh, no, no, absolutely. I'm just
candidly,
joking, but it's also true because I try to treat Alexis as nice, as best possible as I can, just so all my future goals are aligned with the capital raise that I need. But anyway, so let's get into this real quick. So, who is Alexis Morgan? Let's tell people in maybe a couple minutes where you come from, how you found real estate, and how you got to the capital raising part.
yeah, thanks, Chai. Yeah, so my background when I was a kid, I was just like everyone else. I certainly wasn't raising money, definitely wasn't in real estate. I was on a normal trajectory to have, a normal life, W-2, go to school, get good grades. And around my junior year, when I was 16, 17 years old, I started reading books about self-development. The first book I ever picked up was Think and Grow Rich by Napoleon Hill. And that book taught me that there's more to life. You can create more impact. You get what you ask for, and you shouldn't live your life based on what other people tell you. You really need to discover what you want for yourself. And one book after another, I landed on what's the book by Robert Kiyosaki? What's the one that everyone reads?
Rich Dad, Poor Dad.
Yes. One book after another, I landed on Rich Dad, Poor Dad, another, I feel like all-star in everyone's real estate career. And I don't have to tell you guys, after you read that book, you kind of have like a whoa moment, and you can't ever see life the same. And I was like, I need to get into real estate. I was 17 years old. So after encountering that sort of knowledge, ironically, I still decided to go to school. I still decided to go to college. And after 7 months in college, I was in Atlanta at Georgia Tech studying to be an engineer. I just was so miserable. I don't know why. I don't know whether it was the culture, what I was studying. All I could think about was doing this whole entrepreneurship real estate thing. So I took a leave of absence, and I started real estate at 18 years old. I got into the business by wholesaling and getting properties under contract, assigning them to an end buyer. And after doing that for a while, I made some money, and every single dollar that I made, I reinvested into a community, a mentorship, an event, etc. And one of the events that changed my life forever was this one called Fund Launch by Bridger Pennington. He basically taught people how to start a fund, why to start a fund, how to raise money. And after seeing that the biggest players in that room and the biggest players in any space when it comes to business raise money from other individuals, I decided that that's what I was going to do. I didn't even know at the time what I was going to raise money for, but I knew that in order to grow and scale anything, it seemed like you need to be working with investors. You need to learn how to talk to investors and how to raise capital from investors. And so I finally figured out what I was going to raise money for, and it was private money lending. One of the reasons I chose lending was because it had a relatively short hold period. And what I mean by hold period is if you're buying a single family property, it's going to take a long time to appreciate, 5 years, 10 years, 15 years, etc. If you're renovating a commercial building, retail, multifamily, etc., you'll have 5 to 7 years before you can return capital to your investors. When you're lending, your loans can be anywhere between 3 months and 18 months. This is relatively short compared to other things that people are investing in. So lending was super attractive to me. Found a mentor in that space and immediately started talking to investors. I learned a lot by trial and error. There was no one really to show me the ropes, show me what to do, show me what not to do when talking to investors, other than my attorney, of course. But no one really showed me the systems on how to communicate my offering. So the first 3 months that I was raising, I didn't raise a single dollar. And then slowly but surely, 50,000 came in, then another 50, then 100,000 commitment, then a 400,000 commitment, then another 50. And before I knew it, I had raised and deployed 40 million. That's like the number that's probably relevant towards the first end of 2025. I'd have to count now, how much I've raised. I've sort of lost. I don't track it as much anymore, but yeah, raise now tens of millions of dollars, and you're always raising. As a good operator, you're always raising capital.
So one thing I want to point out for everybody is how Alexis, again, I mean, this is what we talk about in underwriting power hour, knowing yourself. And it is probably the most important thing most people ignore. And that just amazes me. Like, so Alexis said she knew she has to raise money, but she didn't know what she was going to raise it for. So that inner self is talking to her, telling her what she is capable of, considering all her past, all her skill set she has gathered in her life. And the combination of that is only you can tell yourself exactly what you're capable of and what your next step is. So when you talk about people that are visionary and integrators, the visionary people differentiate themselves from, the visionaries become visionary by knowing themselves first. Okay, so the skill set, and obviously, like, she has now proven that she has the skill set, she has what it takes to raise larger sums of money, because raising money is one thing and deploying that somewhere is completely different thing. And
For sure.
that if you're not the operator, building that trust in your capital partner is probably the hardest thing ever. I mean, I'm an operator. I'm not a capital raiser. So for me, I'm just, I mean, even when I'm trying to sit in front of these capital raisers and explaining them, I am doing this, I am the guy, I'm signing, it's hard enough already. And I can't even imagine how Alexis must be doing that when she's doing it for operators. So she's not
Mhm.
only underwriting the operator, she's also, I mean, well, she's not only underwriting the capital raiser, she's also underwriting the operator at the same time. So, and we'll get into what I mean by underwriting the capital raiser and underwriting the operator. Is just an analogy I want to share. But with that being said, the next question I have is, when you first started raising capital,
Yeah.
what was the hardest part? Was it finding investors, building trust, or understanding how to structure the deal? Because
Yeah.
most
Ooh,
people are where you were like 2 years ago or 3 years ago.
I think the difficult thing that I ran into, if I'm, hindsight's 2020. Yeah, I didn't
Yeah.
know that this was my problem when I was raising. But if I look at the failures that I had and where I'm at now when I raise money, how I get a yes or a for sure or lots of interest. I think in the beginning, the biggest risk you have is being unclear. I didn't necessarily have a hard time finding investors, and if anyone here is having that problem, I'm happy to help you. I'm happy to help you know where to look. I didn't necessarily have a hard time structuring a loan. I think the conversations were where I had to stumble and fall and fail to perfect them. Because what's interesting about when you're raising money, if anyone's, by the way, by a show of hands, like put a one in the chat if you are currently raising, if you're raising for deals on a regular basis. Would love to see who here actually raises capital on a regular basis. And if you're not, then you will be at some point if you're scaling and growing. Um, yeah, the interesting thing about when I started, and the interesting thing about any capital raiser's journey, everyone wants to see your deal. If you allow it, everyone will want to get on a call with you. Everyone wants to see what you have, but very few people actually convert and commit. Everyone's saying, "Send me the deck." Everyone wants to hop on a call. People will sit there and sort of waste your time or take a look all day long. And when I started, the most difficult thing about when I started is I didn't know how to get people across the finish line. I didn't know, I couldn't differentiate between I'm interested and I'm sending a wire. I thought when people raised their hand and said I'm interested, that money was mine. It's really not the case. It takes two or three or four intentional, structured touch points to actually get money through the door. And so I remember when I first started raising, people would not necessarily say no, but they wouldn't move forward. They wouldn't actually send the wire. They would ask more questions. They would always have some sort of hesitation. And so I had to learn how to overcome that with real, qualification questions and real systems around who should I be talking to? How can I get them to actually send a wire through? Levy in the side chat says window shoppers and looky loos. Yes, that's like if you say I have a smoking hot deal and I'm looking for investors, you'll have dozens of window shoppers and looky loos lined up ready to take up space on your calendar. It's terrible.
So basically, your biggest challenge, or rather, the hardest part was who to pitch it to. Like, who is that? I mean, how do you? I mean, that's what I mean when I say underwriting the capital raiser. And
Yeah.
the word underwriting I use here specifically because we are part of this underwriting power hour community. And whenever I talk about due diligence, I use the word underwriting. So whenever so I'm a private money lender, I'm a hard money lender. Whenever I lend money to people, I uh, I I mean, basically, I'm looking at three things: person, the deal, and experience. Okay, so that person is probably the most important part. And I mean, it's amazing to know that as a capital raiser, you're focused on who you are going to talk to, because I guess everybody wants to invest and very few people actually want to take action. So with that being said, what was that mental shift did you have to make to feel confident about asking? I mean,
Hmm.
let's get into the next. I mean, I want to still talk about how you overcame that hardest part. But before that, I want to understand what was the mental shift, how you started pitching, and where that switch turned or flipped.
Yeah, so I had to restructure my conversations big time because I was having lots of them, but not really making any progress. So I would go back and watch my own calls and say, like, what went wrong here? And I had to become comfortable asking for the money. Something that I did in the beginning and something that I have my sales team or my investor relations team. And on that topic, one thing before we close this loop here, I want to say that raising money is just a glorified way of saying sales and marketing. Raising money is a simple sales and marketing funnel. And so my sales team, aka my investor relations team, something that I did and I had them practice as well was come up with 5 ways to ask these 2 questions. These are by far the most important 2 questions you need to know within if you're stacking your calendar. If you're playing a long game and you're building relationships with people that you know have money, don't take this advice. But if you're stacking your calendar with calls and you're trying to raise money on a strict timeline and be efficient, these are 2 questions you need to know the answer to within the first 15, 30 minutes of talking to an investor. Number one, how much money do they have? How much money do they actually have liquid? Okay. So I had my team come up with 5 ways to ask this question, and I came up with 5 ways to ask it as well. And the purpose behind that is you have to get comfortable asking people, how much money do you have? That was one thing that I was avoiding in the first 3 months of my failures in raising money. The second question is, when is it ready to deploy? How soon are you ready to deploy that capital? We need to know how much they have and when it's ready. If we don't have the answers to those questions within the first 15 or 20 minutes, then we are in a gray area where we're building a relationship with someone who may invest at a later point, but we don't really know if they are qualified to invest. So my team is very focused on qualifying for those 2 things very early on in the conversations. And that was
So
a big mindset shift for me.
when you say my team, I mean, initially, I'm guessing it was just you.
Yeah, for sure.
But eventually, when you say my team, I just want to know more exactly how you structure your team, who does what in terms of who's asking these
Yeah,
questions,
of course.
when do you step in?
Yeah, so I mean, there's people who've invested in my deals that I've never spoken to at this point. I train my team pretty well to take the handles, but I'm raising Fund 2 now. I did Fund 1 in 2023, so I'm raising Fund 2 now. So I've stepped back into the role of being the face and being in the capital raising calls and having these conversations. But originally, there's really like a 4-step process in a way to get people through and get wires sent. The first thing that happens is a cold outreach message. When I first started raising, I would reach out to my entire contact list, but that ran out quickly. I mean, I was 19, 20 years old at the time. My contact list wasn't super built up, so I had to go to a cold outreach strategy, and we still do that today. We probably send 100 to 200 messages each week to potential investors to get calls on the calendar and solicit business. So that's one thing for sure. That's the first thing that happens. I typically will have a VA doing that, at least identifying who we should message, and maybe someone stateside actually sending that message. After that, it's that first discovery call. So that first call, that's one call that my team handles. I usually don't handle the first intake call, and that call lasts anywhere between 15 and 20 minutes. Then we take people into a deeper dive call where we're going over what specific opportunities could look like working with us. So the first call is really getting to know you. Are you qualified, like I mentioned? And if they are, we'll move them into a longer call where we can walk through legitimate opportunities. And then that last touch point, the fourth one, is actually showing them the live opportunity that I'm raising for. So by the time I'm sharing with them the live opportunity I'm raising for, our team has talked to them at least 3 or 4 times, and we know whether or not they can invest, they will invest, and we have taken all of their objections off the table in that longer example mock deal call as well.
Oh, nice.
Yeah.
Okay, I love that
Is
part.
anyone, by the way, I just want to like pulse check here. For those of you guys listening, is anyone like, okay, I'm gonna actually do this when I'm raising money? Because it's easy to just spray and pray. This is the systems that I've trained people on. Chai and I actually are training a couple people together. So if anyone's like, okay, I want more details on this system specifically, feel free to drop a note in the side chat and we'll make sure to
Yes.
get you some more
So,
information on it.
so we are going to talk about this amazing thing that Alexis and like I said earlier, I have to keep Alexis on my side and keep her happy so that she brings me a lot more money. So as part of that initiative, I have decided to sort of partner up. So
Smart.
with the capital raisers. So when I need that capital, I have easy access to it. But we'll talk more about what the opportunity is later. I want her to speak about the capital raising
Sure.
part first. Uh, so now that we've talked about the hardest part and what mental shift you had to I mean, or rather, what mental shift did you have to make to feel confident? What do investors actually care about? Like when you go through these three, four calls
Yeah.
with your data you have, what do they want? Do they want returns? Do they want risks? Do they want to know the operator behind the scenes? I mean, what is that most important thing that people should learn about?
Yeah, it's so interesting that you asked that because, our team, we don't pay, crazy high returns. I'm sure there's other operators out there that may be able to give people high returns. I find that investors care about trust in the relationship. I've never lost anyone's money. I've distributed strong returns, double-digit returns over my entire career thus far. But I have seen operators who have had deals go long or had deals go sideways. And as long as they're communicating with that investor, as long as they're being transparent and they have a real game plan, I've seen investors be totally fine. And so, even in my onboarding calls, when we talk to investors, the most common concerns are, how can I trust you? How can I trust that this deal makes sense? So how can I trust you comes down to the character that you show them. How can I trust that this deal makes sense comes down to the underwriting that you can educate them with, how you guys are coming up with your numbers. That's why underwriting power hour is so powerful and Chai's expertise is so powerful, because that obviously is the capital raiser. You might not want your operator talking to the investor, but having some of that operator underwriting handy is helpful when you're talking to investors. And then lastly, the relationship. So a lot of these investors, they, I mean, especially if people know that they have money, a lot of people treat them kind of weird, right? They treat them like VIPs or they treat them like a check. They're people, right? These are everyday people. And even if they're not everyday people, even if they're loaded, if they're a huge family office, they are still humans with a heart. And so the secondary thing that I practice and that my team practices is we treat everyone like humans. I mean, we make jokes. We talk to people like we talk to people about their families. What are their goals? What are they struggling with? We really focus on building a relationship, not just the deal in front of them. And one of the main things, I mean, if there's one thing that you guys take away from this call, I was on a coaching call this morning. I have a small mentorship group that I train every Saturday. And one of my students asked me, how do you deal with objections if someone's not sure and they don't know if they're going to invest? One of the things that I say in almost every call, probably every call, and how I handle any objections when someone's not sure, I validate them because it is a big decision. I say, look, whether or not you invest with me, we'll figure out. And if you don't, that's okay. I have lots of investor friends and maybe I can point you in the right direction. And if someone's unsure, I say, look, I get it. This is a huge decision. It's a lot of money. I want to be here and make sure that you make the right decision for you. I'm not here to convince you that this is the right deal. It's your job to listen and determine if this is right for you. And it's my job to educate you and show you what I'm up to. And at the end of it, if we work together, great. If we don't, again, maybe I can point you in the right direction based on what you're looking for. And so that is a very human approach I don't go to these conversations looking to these folks like they're check writers, even though they are check writers, they're humans first. And so when you can show someone that you care about them and you don't have some sort of agenda in your head.
So what I like about your answer, and I honestly, I mean, genuinely did not think of it this way before. I always thought, I mean, of course, investors have to care about something, and I'm sure they do. But what you're saying, and correct me if I'm wrong, is they care about, I mean, they care about your approach with them as a capital raiser, and your approach defines whether you're confident, experienced, or you're just a suck up and trying to
Yes.
get money. And that's where you lose trust. So don't be sucking up to them, be real and tell them, I mean, there is risk. I mean, you're
Yes.
investing, there is risk and reward. And this is why I like the deal. Do you agree with me? I mean, if you don't,
Exactly.
that's fine. We can still do other deals. So amazing.
And if anyone ever doesn't agree with me, which happens, I usually educate them on my perspective. I don't say, well, here's why I'm right. For example, my original fund had a 12-year lockup period. The biggest objection that I got was, I don't want to deploy capital for 12 months. It's a little bit long. At the time, I was working with a lot of investors who were more comfortable deploying for 3 months or 6 months. And I'd say, no problem. I totally get it. Here's what typically happens when someone gets into a 3-month deal. They invest their money. There's two scenarios. They invest their money and it goes 3 months and they get it back. And once the money's back, they immediately want to redeploy. And it takes them about a month to do so. So there's a month where the money's stagnant and they're not actually earning on it. And when they get it back, they immediately want to put it back out there. So that's one scenario that can happen. The second scenario that I've seen is that people invest their money. They're expecting to get it back in 3 months or 6 months, and a deal takes longer than they typically anticipated. So things go long. Not every deal goes to plan. So what are your thoughts on that? I'll educate them on the two scenarios that I've seen from my perspective, from my expertise, from my experience, and then I'll say, well, what are your thoughts on that? And it provides them with a bit of food for thought on their limited perspective. People don't disagree for no good reason. Anyone who's sharing something with you is sharing it from their perspective. And so if you can give them another perspective or educate them on another way to think about something, you can slowly but surely bring someone to your side of the table.
So I'm gonna ask a question that I mean, I wanted to give out the answer, but I'm gonna ask Alexis instead as a, I mean,
Okay.
side, more like a tangent, which you guys probably know that I go on tangents all the time. So have you raised money, or rather, can you give us an example of two completely different deals where returns are astronomically different, and why someone invested in like 9% return deal versus 20% return deal, or maybe there was the same investor who invested in both,
For
and why?
sure. Yeah, I would say the return. So I've had investors come in for 8%, and on the high end, I think I've paid out 15% or maybe 18, but that's huge. It's a 10% difference.
Yeah.
And the reality is, it comes back to what I just said. It's the investor perspective. The two deals were really not that different in structure, in protection. They were both first position liens. They were both 6 months. Um, one of them did have monthly payments. The other one was a balloon at the end. But more or less, they are the same structure of the deal. Why in one was I able to get an investor at 8% and the other I had to pay out 15? Well, the reason is it's exposure. One investor was literally coming from a 4% CD. He had all of his money in a CD that was earning him, I think, 4.25%. And so going to an 8% for him was a huge win. It took me a discovery call to find that out. I usually don't blast deals out. I will present them on a case-by-case basis to specific investors. Dynamic pricing, right?
Yeah.
But the other investor, the one who I've locked in at 15%, he's a private money lender himself. He gets deals all the time. He has loads of opportunity. So in order to get him to commit, I had to bump the returns a little bit. And that deal, I was actually in a hurry to get funded. So I was willing to do so. But in terms of the structure, relatively same. The only difference between those two deals was the investor perspective, the investor exposure. And so getting to know your investors, understanding what's a win for them is also really important. The reason I say that is because if the guy who is in a 4% CD, if I offer him 15%, he might be excited. He might. But more often than not, someone who's very traditional is going to see anything above 15%, they're going to get suspicious rather than
Yeah.
excited. They will think that you're a scam rather than being like ready to fund.
Oh
And
my
so
God, this
just
is
really getting to know your
so good.
investors before you present opportunity is important.
No, I mean, I mean, I didn't even expect this answer. That's why I wanted to ask you the question. So if I were to answer or rather present this situation, my answer to you was, in that scenario, like what investors really care about, like returns, risk, or operator. Okay. So I was going to present a different scenario where a 10% return deal is just as good as 20% return deal because the risk reward ratio changes. The
Mm-hmm.
higher risk, the higher reward, a lower risk, lower reward. So my fund that I raise money for, it's low return fund, just like any other private money lender. So my fund pays 9% return as of today. But the risk for an investor is as good as, I mean, nothing compared to investing in, say, multifamily deal where they may or may not see their money again.
Mm,
In my case, all the money that they put, I mean, they invest in my fund goes into first lien positions on single family properties at 70% or lower exposure. So the market has to correct all the way to 2008 level in order to get them their money back. Okay. So that's how safe the investment is compared to a multifamily where you're raising money from investors as a down payment on your loan because you're
right.
buying these 100, $200 million deals and you don't have 30, $60 million lying around. So you're reaching out to investors. So the risk profile is astronomically different. And the same investor is investing in my fund is also investing in multifamily tomorrow
Yep.
because they want to take, or rather they want to have their portfolio, to have diversity in their portfolio. They want to mix and match. They want to add different types of risk in their portfolio. So that was going to be my answer, but this was even better. So this comes back to what I mentioned earlier, like underwriting your capital raiser, I mean,
Yes.
your capital partner, where you need to know their life situation. Otherwise,
Yes.
you will be leaving money on the table. I mean, this is beautiful. Just like, I mean, it makes me think about wholesaling because that's how I started in my career.
Yeah,
If I don't, yeah,
the other thing that I learned in my capital raising journey is you need to be talking to the decision maker. A
yeah,
big mistake that I made in the beginning was I build a great relationship, and then when it's time to wire, they're like, okay, let me talk to my husband or let me talk to my wife.
yeah,
They talk to their spouse. So now this is a little nugget for everyone. Now when we end that 15-minute call, that first call before we go into the longer call, we say, perfect, great to chat, we're excited to move forward. Is there anyone else who should be on that call, any key perspectives or advisors that should join us on this next
yeah.
call where we're going through the opportunities? So yeah.
That is so cool. That makes me think of this one scene from the series Friends, where this guy selling encyclopedia walks into Joey and Chandler's house, and he's like, "Are you the decision maker of this house?" He's like, no. Like, so great,
Love
great.
it.
That's what I'll add on this reel. Let's okay, so let's move on. If you guys got any questions, because that was intense,
That was
everything,
intense. That was a lot.
yeah, please drop them in the chat while we move on to the next one. So, My next question is, how has the way you raise capital evolved over time from friends and family to more sophisticated investors?
Yeah.
And I know you're working on much bigger level now. So
Yeah.
we talk about that.
It's a great question. Like I mentioned in the beginning, I've gone from $50,000 checks. I've even gone as low as like $10,000 checks at one point, but now really focus on a minimum investment around, or an average investment, I should say, around 500K or higher. And so, in doing that, I've noticed how much more important it is to meet these investors in person. And so I've been jet setting since April, since May or June, really doing my due diligence in being boots on the ground in front of a lot of the investors that I want to work with. I looked at my calendar the other day. I've taken 47 flights this year.
Oh,
Absolutely
wow.
insane. I think I'm averaging one flight a week for the last 20 or 20 some weeks. Um, but as you get into these bigger check writers, I was on a call yesterday with the Swiss Family Office out of Geneva, and my team and I are going into Switzerland early next year to sit at dinner with this family. But that
Wow.
could be, 5, 10, 15, even tens of millions of dollars worth of capital that comes in over the next couple months and years. And so in the beginning, a lot of it was as easy as posting online and having an online presence and reaching out and educating investors. And I think that really does work for the retail investor. There's a huge decentralization of investing happening right now in the United States. So if you're looking for the mom and pop or the business owner or the retail investor who might have some money in the stock market and might have some money in the 401k. I think you can absolutely raise capital there, averaging checks anywhere between 50,000 and 300,000, maybe even pushing into the 500,000s, with this sort of online approach, cold message, calls, posting online content. But as I've pushed into the millions and I'm really raising big chunks now, is starting to really be clear to me that these families and these investors, number one, they aren't individuals. So they are usually conglomerates. They're family offices or groups or business owners that have come together. These people have advisors. And so when I was raising in the beginning, you can get on a call with one person, they're the decision maker, no problem. As I'm scaling and I'm growing, it's typically like it's a group decision somehow. There's not just one person who's like, all right, I feel good about Alexis, I'm going to invest with Alexis. It is usually a collective that is making the decision to invest with us. So that's one thing for sure. And then also, it's becoming more and more important to really shake hands, spend time, and not just one meeting. I was in Art Basel last week. I saw the same investor probably 4 times, multiple occasions. We sat down for more than 6 hours. We met for lunch and stayed for dinner, just chatting, getting to know each other, family, likes, dislikes, whatever comes up. But it's much more relationship based, even more relationship based than I ever experienced before, and much longer sales cycle. When I'm raising from individuals in the 50,000 to $300,000 range via online promotion, via cold message, I can usually have a sales cycle from the moment we send a cold message to the moment we get a wire, as long as there's a deal available, of course, of about three to 4 weeks, which is relatively short. On
Yeah.
these on
Still three
this
to four weeks.
Yeah, 3 to 4 weeks. On this side, to get a much larger allocation, it's really probably around 2 months at a minimum,
Wow. So
maybe even
three
three
to
to
four
four.
weeks, sorry to interrupt you, just a thought about why people take 3 to 4 weeks, because sometimes when someone, like if I'm hit with an opportunity that I'm not ready for, like I met Alexis yesterday and let's say I come from oil and gas background, just found out, oh, she invests with operators in real estate space, PML space. Uh, Great. I just learned something new. Now I want to go home. I want to chat it up with like my friends, my
Yep.
wife, I mean, people that I trust. Oh, I met this girl, and then I just want to sleep over it. Okay. And
Yep.
then in that time, if Alexis starts hitting me up like every hour of the day or every other day or even every week, I'm going to get suspicious. Like, I
Yeah.
mean, I
You
don't
can't be
think,
thirsty.
yeah. So you need to be super patient with
Yes.
and believe the process. So, I
Yes.
mean, this is so important. I mean, I feel I had not thought about that, honestly. That's
Yes. Anytime someone's hitting me up like 4 or 5 times in a row to raise money for them, I
yeah,
get I get turned off because it's like
yeah,
if no one's interested in your deals, you
yeah,
like if you don't have anything, like I don't people want
yeah,
what they can't have. It's human nature. And
yeah.
so there's nothing that kills a deal faster than uh, like being thirsty. I forget the term that Oren Klaff uses, but you're like in deal heat. You're like really you
Yeah.
can't be needy.
Yeah,
Neediness
maybe.
kills the deal.
So
Absolutely.
my analogy for this type of scenario, I had not thought about this from capital raising perspective, but when I sell anything, and I mean we are all sales people here, right? So we are all selling something. Like when I'm selling a
Yes.
loan or selling a property, I like to tell people that just be patient because it needs to be like Inception. Like I don't know if you guys have watched the movie Inception properly because everybody's watched it, but nobody really understood it. So take the time to understand what the movie is about. And what it shows you is they are trying to go in their like another level in their mind and planting the idea where in the real life the guy feels like it's their original idea. So the
Mm,
same way the capital partner needs to feel like it's their idea to invest with you even though you brought the opportunity to them. So
yeah.
when it's their idea, then they are doing the job for you. Okay. And you're going to kill that idea by interjecting their evolution process.
Yep.
Great, great point there. But anyways, let's one more. I mean, as we talk about how it evolved over time, just to close the loop on that one, who would you focus on the most? Would you focus more on friends, family, or these big? And I know priorities change, but in that evolution cycle, where do you
Yeah.
focus at what time?
Well, I think friends and family are great if your friends and family have money. You know, if your friends and family are broke, then that obviously won't work. Um, but I think the easiest thing to go after, like for me, you have to look at the cards that you're dealt. And what I
Mm,
mean by that is, like I mentioned, I have students. Chai and I are taking on some students right now. I have students that have really good relationships in the medical world. I have students that have really good relationships in the flight world, aviation world. I have students that have really good relationships in the sports world. And you have to look at what resources do you already have available to you. I can say that for me, when I started, I had real estate. I was 19. Real estate was the only background I ever had. I didn't have any medical friends. I didn't have any flight aviation friends. I didn't have any background. And so that's where I started was I want to talk to people who are already interested in investing in real estate. But if you have people around you who are qualified and you have something in common, going after those people first is the goal. I wouldn't focus on the big guys or the big players or the big investors until you have a track record because that's what they're going to ask you first is what's your experience? What is your expertise? Can you show me your performance? And you can build your performance with your friends and family or your already in common group that you have access to.
Okay. Yeah, no, this is very I mean, also depends, it depends on how much money you are raising or what your
Yes.
background is. Of course, your friends and family will trust you first or support you first in a way. So definitely that's very, very good. Um, was there any moment when you realized capital raising alone wasn't enough and you needed
Yes.
some more control or predictability in terms of where the money is going?
Absolutely. So that's such a good question, Chai. Capital raising is pointless if you don't have good deals. It is absolutely pointless. You should never focus on capital raising if you first don't know what am I actually focused on raising this money for. And so this is where private money lending becomes so powerful, because you do have the ability to showcase performance in a short period of time. If you are raising money for an RV park or a mobile home park or a retail building or multifamily, your investors don't really know whether you're a good operator until the 5 years after the exit.
Oh, yeah.
They can't, maybe you send them some distributions, but they can't really vouch for you. You can't send other
Yeah.
investors to them to vouch for you
Yeah.
until you've performed. And so this is where lending becomes so powerful, because if you can take capital from an investor, 6 months, give it back to them and
Yeah.
give them interest, they'll be your biggest fan. And so this is where the lending aspect becomes so powerful. Why I've partnered with Chai, why I had a previous partner, because lending allows you to build a track record really, really quickly, and that track record attracts other investors.
That is beautiful. So the lending that she's talking about is specifically private money lending. The cycle is short. It's sorry, 6 to up to maybe 12 months at the most. So your investors experience that return of their money, because here is another way to think about private money lending as a way to invest your money. You can be your own private money lender and do the same thing and make more money, obviously.
Yes.
But if you invest money with private money lenders, like if you invest in my fund, or Alexis has a fund that invests in other private money lenders, you're going to see your money come back fast. And when you develop develop a relationship in the future with the banks, you're going to see the same pattern. Every banker wants to see
Yeah.
you make money or make payments monthly. When they have that give and take relationship in literal sense, that builds trust very quickly. So
Yeah.
I love the fact, that you have worked with private money lenders, and that's where we are headed next in our partnership too. But why
Yeah.
lending? So why do you think lending? And you already touched on it briefly, but especially private money lending compared to all other real estate
Hmm.
strategies.
Private money lending is the best. I would love to talk about our two funds for a second. David Henley says, is your fund set up and operated as a fund to fund? Mine is not. I do direct loans. So investors come into my fund. The first one that I had was great. I ran it for 2 years. We delivered 10 to 12% returns to investors. And so now I'm launching another one, and investors come in, and that fund issues direct loans on real estate assets. So it's not a fund to fund. Is yours a fund to fund, Chai?
No, mine is direct too, because mine is going in my own company.
Yeah.
But now most people think lending is risky. How would you explain it in your, we spoke about it a couple times, but how, in your own language, why lending? So because lending pays less return compared to an RV park or multifamily, if they ever see return back, but that's how
Yeah.
they promise.
I think when I think about lending versus ownership, there's two real analogies that I use. The first one is when you buy a property that you own, you have what's called projections. You have a model. You estimate how much you think you're going to make. And if you hit those projections, great. Sometimes you exceed them, even better. But sometimes you don't hit those projections. Sometimes you lose money.
Yeah.
And so when you own, you have an expectation of the future that may or may not come true. When you lend, you have an agreed upon interest rate before that money ever leaves your account. You know exactly how much you're going to make, when you're going to make it, how long it's going to take. The bank, it's the best position to be in if you have a conservative, or you want a predictable income. That is the first reason why I will never leave the debt side of real estate. The second sort of analogy that I give people is, do you call your mortgage company when your toilet's leaking? No. Do you call the mortgage company when you need a new roof? No.
That's beautiful.
Do you call the mortgage company when your tenant doesn't pay? No. Why? Because they aren't the operator. They're not your partner in the deal. They expect their payment every single month, and if you don't give it to them, well, they're going to foreclose and they're going to take the property. And that's that. I never have done a fix and flip in my life. I don't like dealing with these technical, intricate details uh,
Tenants, toilets, and
of
trash.
tenants, toilets, and trash. I like financing. I like paper. I like being behind my computer and taking my laptop and deciding today I want to go to New York and tomorrow I want to go to Bali and the day after that I want to be in Paris. And you can't do that when you are,
So,
when you have to sweep the floor.
I mean, in December every year, I have to make sure, I mean, in order for me to enjoy the holiday time, I have to have completed all my flips out the
Yes.
door. Otherwise, put a tenant in them. Otherwise, I would be miserable.
Yes, you're going to be
Yeah.
stressed. It's everything. So those are the two kind of perspectives that I give people. Number one, I like to be able to predict my income. I don't want to project my income. And lending gives me the ability to, as much as possible that you can as a business owner, predict exactly what I should expect to make. And then the second one is I don't want to deal with tenants, toilets, and trash. I love real estate, but I am not interested in being the operator of that real estate. I want to get paid no matter what's going on with this deal. And the only person who gets paid, no matter what's going on, is the bank. And so financing these projects is
So,
my opinion the best position to be in.
so little segue into private money lending from here. I mean, if someone here is already raising capital, what skills do they need to become a good private money lender
Yeah.
or operator?
Yeah,
Private
you
money.
you need a lot of skills in private
Yeah.
money. There's a long list. The first one is the ability to generate good business, finding borrowers, being able to engage and hold on to borrowers. Chai has done a phenomenal job of that in his private money lending company. Right after that, you need to be able to filter good deals versus bad deals. The worst position you can be in as a lender, if you're going to be a lender, is to lend on a bad deal or lend too much. And so underwriting and being able to underwrite, being able to identify, do these numbers make sense, is the next skill. You certainly need to be able to do paperwork correctly. If you do all your underwriting and your paperwork's not in order, you can lose out on the money that you have invested. And the last skill I would say, like these are the core four that we've talked about today, is you have to be able to raise money. Lending is a capital intensive business. And so if you're going to be lending at all, you have to have some money to lend. If it's not your own, then learning how to communicate with investors, how to negotiate with investors and talk to investors is certainly like a core skill. And these are all things that, I know we're going to go into what we're doing together, Chai, but these are all things that Chai and I both are teaching students on a regular basis.
No, this is amazing. And yes, lending is as a capital raiser, putting your funds in with an operator to lend privately on single family fix and flip loans is probably the best case scenario to build trust fast. But then finding that operator or being one is probably the hardest part you're gonna do as part of that journey. Uh, so if someone wants to go from capital raisings to for deals to building true private money lending business, what would be, say, the first, where do they need to start? And again, we have something coming up shortly, but I want
Yeah.
Alexis to get into that first step.
Yeah,
What
I
do you
mean, I try. I don't know how you built your private money lending business, but the first thing that I did was I got a mentor. And
Yeah.
so in early January, Chai and I are opening up a couple seats for us both to be able to coach some students that really want to build this private money lending business, really want to learn how to raise money. And anybody here who wants to have an opportunity to get into that, we're happy to have a conversation. But when I started lending, I mean, there's so many blind spots and so many mistakes. It's really, there's a lot of education, and you're dealing with, at a minimum, tens of thousands of dollars, at a minimum, on a maximum, millions of dollars. And so you really want to invest in the knowledge to do this thing correctly. The first thing that I did, where to start, is to hang out with people, invest in people who can show you the ropes for sure.
So I have been, like, you guys probably, some of you already know that we've hosted a PML mastermind together, Alexis and I, before. and I've been teaching students privately how to lend money. Um, and I mean, some of you guys are already loan officers with us in our DSCR business. So if you are already in that space, whether you are raising money or you're a loan officer in DSCR space or you're already lending privately, you're lacking one, I mean, two of the three skills. Okay. That's, I mean, when I started doing this and I was teaching my students, and Alexis has probably done the most compared to most of us here. But she's has her own community where she's teaching capital raising. But the gap that we constantly see, both of us in our own world, is we are lacking the other part. So that's why we have decided to come together as a team and bring both sides of the table under one umbrella as a mentorship. And it's a pure mentorship. This is nothing like a community. This is a classroom training. You come and actually learn, because as I keep repeating every call, underwriting or learning private money lending, I mean, these are not things that you go to a meetup and casually talk about,
Yeah.
because it requires repetition, it requires practice. It's like going to the gym. It's like it requires doing the hard part. So you cannot learn these things by watching videos or going to community meetups.
You
Uh,
have to do it. You have to do
you
it with
have
a
to
coach.
actually do it. So if any of you guys are interested, we are happy to talk to you. We have already filled up a few, I mean, well, most of the spots, right?
Yeah.
We are doing a very small cohort. But I mean, after we spoke about it, and depending on the bandwidth we both have, we have added a few more spots at the moment for our first 3 month uh, mentorship, so to say. So anybody that is interested, please reach out to me and I'll connect you with Alexis and her team to go through the discovery call to see if you are a good fit for something like this, because this is a next level mentorship. Like, you don't want to come here fresh without knowing what ARV is,
Yeah.
what real estate means. So that's why it takes a discovery call. But I mean, this was so good, Alexis. I mean, even I learned so much. And in fact, I keep repeating the same thing, but
No,
my
it's always good chatting.
reason why I like to connect with Alexis is, of course, I mean, I see so much potential of us doing so many things together. The way where she's headed right now, that is exactly where I want to be, but I want to be good at what I do as an operator, and she wants to be good at what she does as a capital raiser. So I don't want to do the opposite thing of what I'm doing.
Yes.
Instead, I can partner up with someone like her. So thank
Different
you.
skill sets.
Yeah. Oh, absolutely.
100%.
So if you could go back and build your capital raising journey again, if you were to start over, would you
Yeah.
start with lending sooner? If yes, why? And if no, why?
I mean, if I could have been lending at 15 years old, I would have, I feel like I started
Yeah.
pretty early.
Yeah.
But no, I mean, this is, in my opinion, there are very few things that there are very few things that I commit to like for the rest of my life. But
Mm.
I truly don't ever see myself getting out of this lending business. It's a great way to like at a core understand real estate. It's a great way to work with investors. It's a great way to generate deal flow. It has so many benefits building a true private money lending business. You arbitrage interest, you obviously make money, but it is an incredible business that I'm grateful to have stumbled upon and built so well early on in my career. This is absolutely the space that I'll be in.
And how old are you again?
So I'm 22 now. I feel like I'm getting old. I've
Guys,
been in the
he's
community since I was 18.
22. Oh my gosh. Like, when you
Yeah.
say early on in my career, I just want to clarify, early on is 18 years old. Like,
Yeah.
I don't even know what I was doing at 18 years old. I came to this country at 23. So I didn't have the vision, the knowledge, the know-how,
Thank you,
the
Jeff.
guts, the courage. Oh my God, like, it's amazing.
Thank
So
you.
if anybody, I mean, that's all I had from my side. If you guys have any questions for Alexis, we can hang out here for 5 to 10 minutes more. If not, this has been amazing. Thank you so much for coming and sharing all the knowledge and wisdom you guys
Of
have
course.
built.
I'd love to get the recording too.
Yes, we'll do.
So I think Levi has a question, or maybe Levi. Hopefully, I'm saying that
Yeah,
right.
go ahead, Levi.
Yes. Thank you very much. Firstly, fantastic presentation. Thank you so much for sharing all the information. And first, I'd like to answer a question. You said that you went to Georgia Tech and you don't know why you were so miserable. I'm telling you now, it was the Yellow Jackets. They're everywhere.
Oh boy.
So I'm from Atlanta myself, and so I'm very familiar. So my first question that you did not cover, what is the difference between what you do and fractional, and how do you work with fractional, and what do you think of it as an investment platform compared to what you do?
Yeah, fantastic question. So the difference between what I do and what fractional does, first and foremost, fractional is a capital raising platform. They are like, it's like it's like asking what's the difference between a hammer and building a house. Well, the hammer is going to help you build it, but it won't build the house for you. Fractional is a platform that will help you raise money, but it won't do it for you. You still have to pitch, you still have to raise money, you still have to solicit investors, you still have to showcase why you're a good operator, et cetera, et cetera. But fractional does provide the technology to make communicating to your investors much easier. They do provide the administrative support to make managing your investors much easier. So that's one major difference between what I do and what fractional does. I'm not a tech company, I don't have any software. Fractional operates mainly as a software to help facilitate capital raising for capital raisers to have an easier time working with investors. The other thing that I've noticed about fractional is that it tends to trend with investors anywhere between $5,000 and $100,000. So if you're looking to raise from an unaccredited network or a friends and family network that might have 5,000, 10,000, 15,000, 25,000 to invest, it might be better to pool that capital into one LLC and have that LLC issue the loan. The last thing that I'll say, and the difference between that is, for me, my minimum investment's 50,000. That's it, point blank, period. And so I raised on fraction a little bit, but eventually I scaled out and just started working with investors directly. The last thing that I'll say about fractional is fractional does not operate as a fund. My company is a fund that pools investor capital, and I can only work with accredited investors. Fractional pools capital into an LLC, and every single person who invests in that LLC has a vote. They have voting rights. They have a say in what they're investing in. Whereas in my fund, you come in and you're a limited partner. You know what you're investing in on the front end. And after those funds come into the fund, you are trusting me and my team as the GP to deploy the capital responsibly. So those are three main differences, I would say.
Excellent. Thank you. Now, you mentioned accredited investors. Are you a member of the American Association of Private Lenders? If
Yes.
so, what are the benefits and how has that helped you? And do you recommend it?
Yeah, I just recently joined AAPL. I went to their conference in Vegas. Honestly, it was good to meet other lenders, a lot of good insights, maybe even have a mentor or two coming out of that group. But I would look at the group more of like a mastermind effect rather than something that's going to help you build or get started. I think in order to build or get started, you really need like a direct mentor or to work with someone closely. Like if you're brokering for Chai, or if you come into our mentorship group as a student, we can help you get from 0 to 1. When I look at AAPL, there's a lot of people who are already at level 10. And so when you get into the room, it's more to network, to mastermind, to shoot ideas. But I joined maybe 2 months ago. So would I recommend it? I feel like I don't have enough experience yet to give a solid yes or no.
Excellent. And last question. What would you say are the broad strokes of your general trajectory to get to 1 billion?
Ooh, 1 billion. Oh, haven't heard
Because
that.
you're gonna be there before 30. We know this. Like it's a
Wow,
fact.
before 30, I'm 22. Relax. What if I want to like drink a glass of wine for a year? Okay. 1 billion. I haven't heard that in a while. When I was 18, a mentor of mine, Carl Allen, he looked me in my eye, he gave me his like pen and he said, "You're going to be a billionaire." That is an incredible goal. It's something that obviously I'm striving towards. And I'm also taking my time. I'm not in a rush. I think this year for me has been really about remembering the fact that I'm 22 years old and being able to, smell the roses a little bit after making money in real estate. But the broad strokes that get you there, it certainly comes down to relationships. And that's what I'm up to now, is building relationships with family offices who are on their fourth or fifth generation that manage billions of dollars worth of capital. I think when we talk about billions, it's very, what's the word? We're all desensitized to how much money that actually is, right? A million is a lot, 100 million is a lot, 500 million is a lot, and certainly a billion. And so for me, if I'm going to get there, when I'm going to get there, it's going to take me building those relationships with people who are already there. And so today I'm working heavily on getting in the right rooms with these families who are worth billions and billions of dollars, and seeing if they can take a look at my strategy, or if they want to invest in my deals, or if we have anything in common. And really focusing on studying them, studying how they invest, studying what they invest in. And what I can tell you all for sure, if there's any common denominator that I've found with these families who are worth hundreds of millions and billions of dollars, is that they are heavily diversified. They have some lending, they have some real estate, they have some venture, they have a lot of private equity in multiple different industries. So I think for me, the next 5 years will be about mastering this one thing and then building off of that platform to get into other industries. And from there, we'll inch our way up to $1 billion net worth.
Can happen.
Amazing. Well, you asked about buying wine, and I'm pretty sure you'll be able to buy your own winery. So
Yeah,
congrats.
thanks. Thank
Alana
you.
is very proud of you. Thank you very
Thank you
much.
so much. Thank you.
Awesome, Levi. Great questions there. Anybody else before we conclude the call today?
I love it. I had so much fun, Chai. I haven't done one of these in so long. I've been under the radar for months
Yeah,
now,
I
but I
know.
think I got to pop my head back out.
Yes, we are ready. We are going to do that January. So January, we are starting our first cohort. There is only, I mean, we are only taking, and this is not any other mentorship. This is classroom training every other
Yeah,
week, every other weekend for 3 hours. And then you take homework back. You have to report back with the homework. This is how you become good at what you do, by focusing, just like we talk about in our loan officer calls. Give me 6 months of your life, and I will help you build that active income in the same
for
industry
sure.
that you want to build your career in.
For
And
sure.
this is one step further than that. And this takes a lot of time on my part and Alexis's part. That's why it's a paid mentorship, but also paying for something makes you, I mean, accountable for that thing yourself. And that's where it's coming from. And I hope you guys enjoyed
Listening.
Alexis talk about capital raising first. And I hope you guys uh, have opened up your mind to the possibility that a 22-year-old has already achieved in her life. So I hope that helps everybody. Thank you so much for attending the
Thanks,
podcast today.
everyone.
Thanks, Alexis. And we'll see
Thanks,
you
Chai.
guys next Saturday.
See ya.
Thank you.